One of the reasons that Bitcoin is winning is because it has a very long natural frequency at its base layer. Frequency of the network is key to the stability, the security, and the success of the network. The key of Bitcoin is it is that natural frequency, and that's, by the way, and that's what protects the network or provides the network security in what I'll call a tactical sense. On any given day, you have to go through that wall of digital power, and you don't have, and all the power is controlled by the network. I'd invite you, if you want to analyze any competing network, put any competing network, any other crypto network on the same framework and ask, how many dollars of real capital have been invested, and how much real electricity is running it, and how much digital power is behind it, and then how many people hold it. Have you ever seen that picture of the Verrazano Narrows Bridge where they engineered the bridge with a natural frequency which resonated with the wind? The wind blew over the bridge and shook the bridge apart because it resonated on the wrong frequency, and the bridge fell apart, literally destroyed the structure. So if you're a good civil engineer, you have to ask the question, am I designing a structure that is not going to shake itself apart? So if you look at the dynamics of the network, one of the reasons that Bitcoin is winning is because it has a very long natural frequency at its base layer.
In this video, Michael Saylor explains the security architecture of the Bitcoin network, as well as the future outlook for Bitcoin, delivering a compelling evaluation of Bitcoin as a digital asset. He discusses the mining computing power and electrical security that protect the network from fraud or hacking, emphasizing that hacking the Bitcoin network is impossible. Saylor draws the conclusion that the overall integrity of the network is robust. He identifies 4 critical pillars that uphold Bitcoin's network and ever-increasing value. Make sure to stay till the end of the video as Michael Saylor explains these critical pillars. As we bring you more clips from the interview, take a moment to like the video, subscribe to the channel, and turn on post notifications for more video like this. You can join the conversation by dropping your thoughts, comments, and observations in the comment section below. Everything you do helps with YouTube algorithm and immensely contributes to the channel growth. Thank you and enjoy the video.
The transaction frequency is 10 minutes, and in a growing network, right, we'll process blocks 9 minutes 30 seconds or 9 minutes 40 seconds or something, because you're always biased to be growing. In a contracting, a bear market, if you're shutting down hash power, we'll process blocks a little bit slower. But generally, you'll be around 10 minutes, plus or minus a bit. And if you get way off, then after 2 weeks, the difficulty adjustment kicks in, and you get basically tuned back to that 10-minute center. I think that's an important part of the frequency of the network, but it's probably not the thing that makes it most successful. What's more important is the mining dynamics and the machinery dynamics. So the question really is, how long does it take to bring on a Bitcoin mining center? It's like I put $100 million in front of you and you want to invest it in Bitcoin. So it takes you 6 months to a year to acquire the equipment, another year to engineer the mining center. So it's like a 2 or 3 year exercise to bring it online. And then the question then is, well, what's the payback time? And that's probably another 2, 3, 4, 5 years. So when you're a miner, you're looking at making an investment and getting paid back 6 years after the initial decision, probably 4 years minimum at this stage. It could be as long as 10 years, 4 to 10 years. So the natural frequency of the miners is 4 to 8 years. And that means that if you're not profitable, you're not just going to shut down the mining operation in a month or 2 months or 4 months. You've actually got to stick it out for 4 to 8 years. And one of the other dynamics here is because the miners are running digital power centers, and the digital power is SHA-256 hashing, that means that if a miner goes bankrupt, if you look at how the Bitcoin network fails, it fails very gracefully, if not at all. All of that hash power, the 500 exahash, it is being run by a network of miners. And in hard times, when the price of Bitcoin falls and the transaction revenues fall, the first thing to fail is the equity. What you can see there is the brilliance of the power protocol is it's unique. And once you've actually taken $10 billion of capital, fungible capital, and converted it into $10 billion worth of Bitcoin mining rigs, it's a one-way transformation. You can't transform the capital back. It's sunk capital. The only thing you can do with it is power the Bitcoin network. And it doesn't really matter whether any individual Bitcoin miner succeeds or fails. So the real beauty of Bitcoin is it is that natural frequency, and that's, by the way, and that's what protects the network or provides the network security in what I'll call a tactical sense. On any given day, you have to go through that wall of digital power, and you don't have, and all the power is controlled by the network operators, not by you. So that's a tactical, the tactical defense system for Bitcoin. The strategic security, or the long-term security, and here I mean security over 100 years, over a century. The security that keeps Bitcoin from being banned, or keeps a government from seizing all of the Bitcoin miners, etc. That comes from a combination of economic power, electrical power, computing power, and political power. So the Bitcoin miners, they're channeling electrical power and computing power, right? So they're the physical part, but the political power comes from the hundreds of millions of people that own something that's a derivative of Bitcoin. Whether you own MicroStrategy stock, or whether you own a Bitcoin spot ETF, or whether you own stock in Block, or stock in Coinbase, or whether you own the Bitcoin itself. I mean, all of these things, put you into the political community, and you're going to use your political power to lobby. And then the other thing that really secures Bitcoin is economic power. And I think that it's worthwhile to point this out, because this is an artifact of Satoshi's brilliance. Satoshi created an immaculate conception, and we had a fair launch. And those million Satoshi coins never moved, and there was no pre-mine. And that means that the only way you have Bitcoin right now is you spend a huge amount of money on equipment and electricity to mine it, and capital to create mining centers, or you bought it with real cash. And we can back calculate how much money's gone into mining, but I don't think it's unreasonable to suggest $20 to $40 billion has gone into the mining ecosystem. I mean, you can trace billions of dollars of capital just to individual companies like Marathon. So you can trace a huge amount of capital that's been put into this network. And ultimately, the security of the network is going to come from the actions of the people as voters, and the actions of the economic actors, the capitalists, and then also from all the businesses, the application companies like Cash App or Coinbase, have an impact, and then the miners have an impact, and they all have lawyers and CEOs and lobbyists and employees, and they have nexus, and they pay taxes, and therefore they have supportive mayors, governors, senators, etc. Now, this is an interesting framework. I'd invite you, if you want to analyze any competing network, put any competing network, any other crypto network on the same framework, and ask how many dollars of real capital have been invested, and how much real electricity is running it, and how much digital power is behind it, and then how many people hold it. You go to the next one, Ethereum, for example, right? You realize after the merge and the proof of stake conversion, no electricity is backing it, no digital power is behind it, right? So you pretty much took out 2 of the 4 legs, 500 exahash versus nothing, and 15 gigawatts versus de minimis nothing. And then the next question is, well, how much economic power? Well, if 70% of ETH was pre-mined, Name one person in the world that will admit to investing $100 million in ETH. I've never heard of anybody. Like when I announced that I personally put $175 million into Bitcoin, there's nobody in any crypto token for the next 5 million tokens, right? After Bitcoin, go to ETH and then go to every other token. You won't find a single person, to my knowledge, that ever admitted to investing $100 million of cash in any of them, much less $1 billion, much less $5 billion. If I had to guess, right, how much real money's been put into Ethereum? A few $1 billion? Like the difference is 600 billion in Bitcoin. If you were to say 6 billion, I would say you might be stretching it, right? Like we're talking about a factor of 100 difference. Yeah. I don't think you can really get to a number that's more than a few billion, right? So I think that 99% of all the real capital has been put into this one network. So if all the economic capital is in one network, if all of the electricity is on one network, if all of the digital power is running one network, the only thing you've got left is political power. And the truth is there are a lot of crypto token holders, right? There are a lot of ETH holders. So really those networks are primarily secured by political power and the voice of the people, much more so than the actual physical power or economic power that's behind Bitcoin.
There you have it. Michael Saylor's insightful analysis of Bitcoin network integrity and his breakdown of the 4 pillars that support Bitcoin compared to Ethereum. Michael highlights these pillars as computing power, electrical power, economic power, and political power. What are your thoughts on the Bitcoin network protocol? Share your comments and observations below. Don't forget to subscribe to the channel and give this video a thumbs up. Thanks for watching.